Hi, welcome to the webinar today on the tax-free retirement. So we're going to teach you how to live a tax-free retirement today. So if you're a fan of not paying more than your fair share in taxes, then this is the webinar for you. So my name is Joe Schmitz. I'm the founder and CEO of Peak Retirement Planning. We are a boutique firm that specializes in tax planning and retirement planning for our clients, and we are out of Columbus, Ohio, but we have clients all across the country. And so we are honored to be here presenting on behalf of Workshops for Retirement here today. It's an awesome organization. They do workshops across the entire country. We do a lot of in-person workshops for them. We do a lot of webinars like we're doing today. And our goal is just to spread the education around and make sure that people are in the best place possible as they plan for retirement there today. So today is one of my favorite webinars that we do, the tax-free retirement, because if you know anything about me, I'm actually the author of this book called I Hate Taxes. And I want to be very clear, I do not mind paying my taxes. Like, I'll pay my fair share, but I don't want to have to pay more, and I don't want to have to tip Uncle Sam is my concept. And I just don't technically believe that the government is the best steward of all of our tax-paying dollars. So in my mind, I want to find ways to save money on taxes through legal ways by opening up what the tax code says and what rules are in there, what loopholes are in there, so that we can save money. Because at the end of the day, the government gives us that tax code. It's an opportunity. They give it to us as an opportunity to save money on the money that we've earned all of our years. So that's what that book is all about, is lowering your taxes and owning your retirement. Today's presentation is actually based on many of the topics and strategies that we talk about in that book. And you're going to hear a lot of the philosophies and concepts that I discuss in that book too there as well. So if you want to learn more about this topic, that's a great way to do it through the I Hate Taxes. And we try to educate people as much as we can. You know, you can see we're doing this webinar today. We do a lot of workshops in our community. We have a YouTube channel. We write articles that get published in Kiplinger. We're on radio and TV here in Columbus, Ohio. So it's just, we can't say it enough. We can't tell people enough about how to save money on taxes. And if you ask me, I actually think it's one of the least things talked about when you speak to financial planners or just people in the retirement space. Taxes are not talked about enough. And in my opinion, taxes are going to be the biggest expense in your retirement. So we've got to find ways to reduce it over time is ultimately the goal. And we're going to show you many strategies here today so that you can be educated to start doing this stuff right away and start taking advantage of it here this year. And so, a few disclosures here, as I mentioned, we are not affiliated with Workshops for Retirement. We have a for-profit firm, Peak Retirement Planning. I joke with people whenever I do these in person. There's no steak dinner in front of you, so I'm not trying to sell you anything here today. It's simply education, making sure you're in a better spot. But if you are looking for more specific guidance, or you are looking for what we call part 2 of this workshop. So today is just really, the general information. We're just trying to open your eyes to different strategies. If you want to get further questions answered, then you can actually schedule a time to us with us, and I'll have someone on our team go ahead and pop that up for you there. And then you see that later on you can schedule a time with us, and it's completely no cost. The reason why we offer that is because obviously a lot of people have questions that we aren't able to answer during this workshop today. We're going to try to answer as many as we can during the time that we have, but there's obviously going to be some that we don't get. So if we don't get to your question, just schedule a time. We have 7 advisors at our firm, and we try to free up as many times as we can on their calendars to make sure that we can get your additional questions answered there. And that discovery session is also a chance for you just to get an analysis of your current situation. We can try to pinpoint anything else you're not getting done just to make sure you're in the right place. So if you find yourself today thinking, man, this is complex, retirement's complex, man, I think I may be missing things when it comes to tax planning. That's what that session's for, is just to make sure you feel more confident in implementing some of these strategies. So we know that when we do these webinars and workshops in person, we know a lot of people want to schedule that. So we always make sure we can free up enough time so that you can get the help that you deserve, is what we're all about. Obviously today is general, as you can see on the screen there. We're also going to talk about some more advanced topics today. I'm going to make it sound very simple, so just make sure you get the right type of guidance, whether that's a CPA or your financial planner who specializes in tax planning. Just make sure you get the right help. Don't try to do these strategies by yourself. You could, and if so, go for it, but I would highly advise that there's a lot of mistakes you could make if you're not understanding things fully. So that's the disclosures there for you, so you don't all sue me, and I can continue to do what I love every single day. So let's get going here into the workshop here in the webinar and show you some strategies. So before we start here, I want to show a picture of my nephew here. So this is my nephew, and this is the look he gives me on his birthday every year. And as you can see, it's not the best look. And the reason why is because I don't give him any physical gifts. I do something for him instead of putting money into an investment for him. And so obviously, a 4-year-old, he'll be 4 here soon, he doesn't understand that concept. He would rather have everything right now. He's not going to understand what the value is going to be in 20 years today. But in 20 years, what type of look is he going to give me? Of course, we're going to be best friends, and here's the look that he's going to give me. And this is actually after he bought me a nice dinner and took me on a ride in his sports car and all the fun that we had, right? And so my point with this story is understand that retirement is very complex. And we often get people who come and see us for the first time from a webinar like this of, man, there's a lot I need to accomplish in retirement. I now have to worry about taxes and retirement that are different than I've ever seen before. I've got to worry about market volatility. I've got to worry about inflation. I got to worry about when do I take Medicare. I need to make sure I have an estate plan in place. I need to make sure I decide when to take Social Security. There's so many decisions, and 1 or 2 mistakes can be extremely costly as you prepare for your retirement. And so our goal today is to try to help you make retirement simpler, to try to have a little bit of sunshine at the end of the tunnel so that we can have this look throughout retirement and live the retirement that we want to, travel, spend time with the grandkids, whatever that may be for you, so that we don't have to worry about running out of money and worrying about missing opportunities. And if we can specifically do that with tax planning, if we can implement the strategies we talk about today correctly, you can save a lot of money through tax planning. Hundreds of thousands of dollars is what we were able to show some of our clients of what they can save over time. Even more than that, depending on your situation. So we need to make sure we have this area of our financial plan tight. So that's the idea of this workshop webinar. So we want you to have that look by the time you log off of this. And so here's another fun story. By the way, I like telling stories, so if you don't like stories, this may not be the best one for you. In my mind, I think stories are the best way to memorize things and to have takeaways to make sure that you do them. And, I had a mentor. She's been in the industry for 40 years. She's now retired as a financial planner. And she told me, tell everything, explain everything at a 4th grade level because that's what people are going to understand. And it's not to insult anyone's intelligence. It's just the fact that not everyone does this every day. People typically have a full-time job that is outside of financial planning. And so we want to make sure we can really simplify things so you truly know what you're doing and you're not overwhelmed. Make it simple. And so the blueberry story is a fun one to me. So my mom, she absolutely loves blueberries. And the other thing about my mom is she loves saving money. So she came from a big family. And if you know anything about coming from a big family, you don't get a lot. And you got to make sure you preserve what you get, right? And you got to work extremely hard. So that's the mentality she's had all of her life. And so I was over at her house the other day, and there's a bunch of blueberries in the freezer. And I asked Mom, why do you have so many blueberries in the freezer right now? And she goes, well, they were on sale, and I just stocked up. And that's my mom, because she knows she's going to use those blueberries, and she doesn't want to go to the store in a few weeks and have to pay way more for them. She can freeze them and use them whenever she wants. And so if that's you today, I've got good news. And I've got good news when it comes to tax planning. And the reason why is because right now today, taxes are what I call on sale. And so what do I mean by that? Well, right now, taxes are among the lowest that they've ever been. If you look back in our historical tax rate environment, you'll see we're among the lowest that we've ever been, and I'll show you that here soon. And then I always ask the question of what do you think tax rates are going to do in the future? Do you think tax rates are going to go up, or do you think tax rates are going to go down? And I've never had someone tell me that they think tax rates are going to go down. And the reason why is because we're $33 trillion in debt. We have a lot of liabilities that we still have to pay out, Social Security, Medicare, that are underfunded. Where are we going to get the revenue to cover this debt crisis? And most people would suggest that taxes have to rise. Now, they could reduce spending, and you can be the judge if that's going to happen or not, but that is an option. They could raise inflation, so those are all options, but most people suggest the taxes are going to rise, especially if they're among the lowest that they've ever been. And so if they're lowest they've ever been right now today, and they're set to be higher, don't you consider that a tax sale? And do we want to take advantage of this tax sale today? And I'm specifically talking to you if you have a large amount in tax-deferred investments. 401ks, IRAs, if you have a larger amount in those, I'm talking to you. I'm talking to you that we may want to look to pay our taxes on those investments now versus later at higher tax rates. And that's one of the bigger concepts that we're going to discuss today, to make sure you have a plan against those retirement tax time bombs that I call those 401ks, those IRAs that you have not paid taxes on yet. And so with this blueberry sale, we got a current blueberry sale going on for the next 2 years. We've got till 2026 to make sure that we're planning for this tax sale to go away. And so the Tax Cuts and Jobs Act was enacted in 2017, and it's going to expire in 2026. And so for the past 5 years, tax rates have been lower than what they're going to be in 2026. So in 2017, they're higher than they are now. And so we've really got 2 years and actually a couple more months of planning for 2023 to make sure that we can use 2023, 2024, and 2025 to use this tax sale to our advantage. So the window's closing on us here. And if you ask me, I don't think we're ever going to see lower tax rates in our environment, even beyond 2026. And so we need to make sure we're planning for it today before the window closes, is the thought here. So let's talk a little bit about the federal income tax rate. So right now we're going to talk about federal taxes. So if you look at federal tax rate, if you have $85,000 of taxable income and you follow my chart here, you're going to be in the 12% bracket there. So not too bad. If you are single and you have $85,000 of taxable income, you're going to be in the 22% bracket. So it's obviously a misconception that we see often is, hey, I'm in the 22% bracket. I have to pay 22% on everything of that $85,000 of taxable income. And that is actually incorrect. You only have to pay 22% on the amount above $44,000. So let me just walk you through how this tax code actually works. So we first start with what we call our standard deduction. And if you are married, filing jointly, and have $27,700 of income, you pay no taxes. If that's all you have, you pay no taxes if your income is under $27,700. So if you're taking notes, I highly recommend you write that number down. And if you're single, write that number down of $13,850. And the reason why is because if you don't want to pay any taxes for your retirement, then there's something called the 0% tax bracket, and that's where you keep your income below that standard deduction. And if you want to live a tax-free retirement, that is our goal, to keep our income under that point. And so how do we do that? By having a plan and preparing for it now, so that in the future, we can show Uncle Sam that we have less income. And I know what you're thinking. I don't want to live on ramen noodles. I want to enjoy my retirement. I'm going to live on more than $27,700 of income. And I'm going to show you an example later on where we had a client that lives on $100,000 every single year, and they have legally divorced the IRS from a federal income tax rate for the rest of their life. They no longer have to pay Social Security tax, no capital gains tax, because we have planned the right way. And so we're going to show you how to live in that tax-free environment there and stay in that standard deduction through tax-saving strategies starting now and moving along. So that's something that we're going to make sure we can show you how to do by the end of the webinar here today. So then after you utilize this standard deduction, you would then, let's say you're married, the next $22,000 above the $27,000 would then be taxed at 10%, and then any amount above the $22,000 would be taxed at 12%. So you can see it's a marginal bracket. You don't just pay that bracket that you end up in. Okay, so that's how our tax code works. So let's move along here. 2023 tax rates on top of the slide here, as you can see. Down below that is 2017. What do you notice is the difference between these two tax brackets? Well, there's two differences. First is a standard deduction. So remember first why I'm telling you 2017. And the reason why is because that's coming back in 2026. So we know that these rates are going to come back here soon, and so we've got to be preparing for it. So not only are the standard deductions getting cut in half, but also our tax rates are going to be higher. And so if you're in the 12% bracket today, you're going to be in the 15% bracket come 2026. If you're in the 22% today, you'll be in the 25%. 24%, you'll be in the 28%. And so, as you can tell, I've got a pretty good sense of humor, at least I like to think so. And I'm going to ask you a really hard question. Would you rather pay 12% or 15%? Would you rather pay 22% or 25%? 24% or 28%? So I think you see where I'm going here. Tax rates are currently on sale, and we've got a limited time before we take advantage of this. If we do nothing and our situation stays the same it is today, and we don't change anything and our income stays the same for what it will be in 2026, you'll end up paying almost 20% more in taxes is what our analysis shows. if you have $10,000 that you're paying in taxes every year now, in 3 short years, you'll be paying $12,000 in taxes is typically what we can see or expect for someone in that type of situation. And so if you don't want to pay more in taxes and you want to be tax smart, we've got to make sure we're utilizing this current tax sale. So that's the idea there with the changes in 2026. So in the next slide, I'm going to show you the historical tax rate environment over the past 100 years, basically. And if you look at our highest tax bracket today, it's 37%. And if you look at what it will be in 2026, it's going to be 39.6%. And so the question I have is, what is the highest tax bracket of all time? And some of you may know this answer, and I would tell you to put it in the chat, but we have the chat private, so you can put it in the Q&A, but the Q&A can only be seen by us. The people who are on this webinar will not be able to see that, so just know if you do have specific questions, if you ask it there, that will be only looked at by us, just FYI there. But when you look at the highest tax bracket of all time, it's actually been much higher than these two that you're seeing here. The highest tax bracket of all time was actually 94% after World War II. And you're probably finding that hard to believe, but check this chart out. Here we are today, about the 37% bracket like we talked about. Back in 1945, it was 94%. In 1981, it was 69%. And so, as you can see, taxes are on sale right now, and they've been much higher over time, and they've been among the lowest they've ever been right now. And so the question I have is, where are tax rates going to be here moving forward? Are they going to go higher, or are they going to go lower? And if you expect tax rates to go higher, we've got to start planning now. Why are we waiting? We've got to get ahead of this. Do we really just want to put our trust in Uncle Sam and trust that he's not going to raise taxes? Because if you just stay status quo, if he doesn't raise taxes, then you're fine. But if he raises taxes, you're not fine. And so we need to make sure we have a plan against how we do this. So let's start talking a little bit more about strategy after we talk about these 401ks and these IRAs that you currently have. So most people we see have a lot of money in these tax-deferred investments. 401k, IRA, TSP if you're a federal employee, deferred comp, 457, 403b. And this type of investment, you have not paid taxes on it yet. And so when you go and take money out of this in retirement, what happens? You got to pay taxes. And so when you put money into this 401k up front, you put in $10,000 up front. And that was great up front because you got a tax savings. And we like tax savings, so that was great. But what happens is this $10,000 turned into $100,000. And now if you want to take out $100,000, what happens? You've got to pay tax on that full amount. So you saved on 10, but you paid on 100. And I joke around and say, is that a good deal? And so we have to understand with this tax-deferred investment that whatever you have here, it may not all be yours. And the reason why is because you may have a partner on this tax-deferred investment, and his name's Uncle Sam. And so I'll tell you a funny story. We had a guy who came in and saw us we did a virtual with him from one of these webinars. And on the screen, he was showing his statement. He said, I got $1 million in my 401k. I'm ready to retire, and I'm hoping you can help me do this. And I had to joke with him a little bit. And I said, I don't know. You don't have $1 million. He said, yes, I do. And through the screen, I could see him put it right in my face. He said, here's my name, $1 million. And I said, yes, but you're missing something. What is he missing? He's simply missing a name next to his, and that name is Uncle Sam. And so we have to understand that this investment is jointly owned by Uncle Sam. And he's going to be there until we either kick him out or until he forces us to pay him up. And when does that happen? RMD age, required minimum distribution. We'll talk about that soon, but when you turn 73 or 75, that's when you're going to be required to take out money from there, and that's when the government is going to force you to do so. And I don't know about you, but I don't think it's a good thing when the government forces you to do something, but that's simply what an RMD is. So that's the tax-deferred investment here. So as you can probably tell, I've bashed this pretty hard here over the last few minutes. And you're probably thinking, man, I got a lot of money in tax-deferred, and I must not be making the right decisions. I must have not have done this right. And I'd actually almost argue that. I'd actually say that if you have money in the tax-deferred investment, you've probably done the right thing over time. And why do I believe that? Because what were tax rates in 1981? Federal tax rates were 70% in 1981? Well, you're probably working back then. You're probably putting money into your 401k or probably getting your match. And it was okay to defer a tax rate this high because if you defer it at 70, well, maybe in the future we can pay it when tax rates are lower, like today when they're 37, right? Whereas if it's a 70% tax rate, we probably don't want to pay that tax rate at 70%. We'd probably rather have that savings and pay it later at the lower rate like I just mentioned. And so if you do have money here, great job. You did the right thing. But my question to you is, are you doing the right thing today? Are you doing the right thing today when tax rates are now on sale? Have you been making any transitions from this tax deferred into other vehicles over the last 5 years while tax rates have been on sale? And if you have not, you've probably been missing opportunities. Now, this is not a webinar for me to beat you up, but it is to be real with you and to make sure that you're doing the right thing, because I'm going to tell you what you need to hear, not what you want to hear. And so if you haven't done anything in the last 5 years, you've probably missed opportunities. If your financial planner hasn't brought this up, they're probably not doing the tax planning for you. And so we can't change the past, but we can change the future. So let's not dread on that, but let's start moving now, because remember, we've got a few short years before this tax sale is up. And so we've got to get moving now is ultimately the idea. So what are some alternatives, or what are some different ways that we can start planning on having less in our tax deferred? Well, the main thing I want to talk about here today is what we call the tax-free bucket here. The tax-free bucket is going to consist of your Roth IRA, your Roth 401k, any type of tax-free vehicle. So we're mainly going to talk about a Roth IRA today. So with a Roth IRA, when you put your $10,000 in up front, you don't have to pay, or you don't get any tax deduction. You have to pay your taxes up front. And so no one likes that. But when this $10,000 grows to $100,000 and you take $100,000 out, how much tax do you have to pay? That's right, zero. You live that tax-free retirement from that vehicle. And so we often joke, but if you had a magic wand, where do you want all your money? Which bucket? And ultimately everyone says tax-free. So my question is that where you all have all your money? And typically the answer is no, because most people have their money in tax deferred. And so if you look in the national average, there's over $30 trillion in the tax deferred bucket. That's 3 followed by 13 zeros. It's a big number. Write that one out. The tax-free bucket only has less than $1 trillion. So there's over 30 times more money in this bucket here than this bucket. So if they were to size these buckets, this would be much, much larger than this little guy who only has less than 30 times what is in here. So that is the difference of the amount here. So if I have to ask, why does everyone want their money here but everyone have it here, is probably what you're thinking. One of the main reasons is just strictly because of education. No one's talking about this stuff, and that's why we're trying to get the information out there, because people need to understand this tax story. People need to understand how to be tax smart. Because if you're not tax smart, you're going to be paying the government way more money than you want to in retirement. If you want to pay more taxes, then totally fine, don't listen to me. But if you want to save money on taxes, you've got to get going. You can't just keep waiting and hoping that things are going to get better. Now's the time to act. And so we're going to talk today about how can we change this? How can we have more of a balance between these two buckets? Instead of having everything in one bucket, how do we have more of a balance, right? I often ask, do you have all your money invested in Bitcoin? Of course not. You followed the rule of don't keep all your eggs in one basket. And if you're doing that, great job. So I have to ask, you're doing that on the investment side, but what about on the tax side? With your investments from the tax side, are they diversified? Do you have all your money in tax deferred, or do you have some in tax deferred and some in tax free? Most people would say they have most of it in tax deferred, right? I would not say that's very diversified. You do not have tax diversification if that's the case. And what I mean by that is if you need $20,000 in retirement from your investments, you're going to be forced to take it out of tax deferred, and you're going to be forced to pay whatever tax rate Uncle Sam tells you to pay at that time. And do we know what that tax rate is going to be? We have no idea, because the tax code is written in pencil. So we have to make sure we're planning for that. Okay? So how do we plan for this? Well, I'm going to tell you about a strategy today that you can actually start doing today. The only limit on this type of investment is you have to have money in the tax-deferred vehicle, and then you just have to make sure it's right for your particular situation. But this strategy is called a Roth conversion. And a Roth conversion is when you move money from the tax-deferred to the tax-free. And this is one of the more popular tax planning strategies that we're seeing right now today. If I were to just present on one topic, one tax planning strategy, and that's it, it would definitely be a Roth conversion in today's age because it's the most universal in my mind, and it's one of the most powerful to take advantage of the low tax rates now before they go up for good. And so that's the idea of a Roth conversion. So with a Roth conversion, I like to think of it like this. So I'm from a very small rural community here in Ohio. It's called Kerr, Ohio. And down in Kerr, Ohio, there's one traffic light, and sometimes it works, and there's a lot of farmland. And my best friend down there, he's actually a farmer. He owns a lot of farmland, and he owns an apple orchard. And so I asked him, would you rather pay tax on that little seed that you plant every year? Or would you rather pay tax on the harvest that you reap at the end of the year? What do you think he says? Of course, he'd rather pay tax on the little seed because it's not going to be as much. So let's think about this with your investments. Would you rather pay taxes on that seed up front? Or would you rather let your investments grow over time and pay taxes at a much higher amount in the future? For example, if you have $1 million today, the rule of 72 says that your money will double in 12 years if you get a 6% rate of return. So your $1 million will turn into $2 million. Would you rather pay taxes on $1 million or $2 million? And would you rather pay taxes at lower rates today or higher rates in the future? And so that's the idea of the seed or the harvest. So I hope that can help you understand this Roth conversion idea here. And here's another point to drive it home is a whole Fram oil filter commercial. So I don't know if you remember this commercial. My mom loves this commercial. It was played back in the 70s. And he simply says, you can pay me now or you can pay me later. You can buy a $4 Fram oil filter today, or you can pay me $200 in the future to fix your problem. And then he shrugs his shoulder, he looks in the camera, and he says, the choice is yours. And I think this is what Uncle Sam's trying to tell us. I think Uncle Sam's this Fram oil filter guy. We can pay our taxes now, or we can pay it later in the future. So that's how Roth conversion works. The main thing I want to understand with the Roth conversion is it's not for everyone. But I would highly suggest that majority of people should be doing this right now. When I look at our clients currently, the ones who have saved a lot in tax-deferred money, most of those clients are doing Roth conversions today. And maybe they're not converting everything. Oh, here's a funny story on that concept. Had another guy from actually one webinar just like this. We did a virtual Teams meeting after this, and he said, Joe, I've got $3 million. I loved your workshop. I'm ready to convert everything. And I go, oh, you want to pay $1.2 million in taxes? And of course, he did not want to do that, did he? And so what we looked at doing with him is we just did a smaller amount over a certain amount of years. And so that's what we would typically recommend for people to do. And especially over this next 3 years, right? These tax sale, now we probably want to get looking to move right now today. And so that's the idea that we're looking at when it comes to these Roth conversions. And again, most people shouldn't do Roth conversions, but another one of my friends, he's another tax planning expert in our industry, he says that 85% of retirees should be doing a Roth conversion. So not everyone, but the majority of people should be doing this. And if you're not sure if you should or not, you've got to run your numbers. You've got to do a detailed analysis to see, is this something you should do or not? It's not something to just say, yeah, I don't think I'm going to be right for this. I'll just pass it by. I would highly suggest you get the numbers. We've had a lot of people come to us and say, I don't think I should be doing Roth conversions. And we're actually able to show them the numbers to show them that it actually does make sense. We can show you our tax planning software that it actually does make sense to do conversions now. You actually end up with a higher net worth in the future. You actually end up with less money paid to Uncle Sam over time. And so you just have to be tax smart and understanding what are your situation today and what's it going to look like every year ongoing is what we will look at there. So that's the idea of a Roth conversion. So the other thing to understand with a Roth conversion is not a simple decision. You got to worry about how is this going to impact Social Security taxes today and in the future, Medicare premiums today and in the future, capital gains tax. You got to worry about what deductions and credits you're going to phase in and out of, net investment income. There's a lot of things to go in with this conversation. So I'd highly recommend you get help from a professional to make sure you're running your numbers right. Someone who specializes in tax planning, someone who not only has the expertise, but someone who has the software in the team to make sure you're making these right decisions is ultimately what I recommend when you're making some more advanced decisions like a Roth conversion. So hopefully that can be fruitful there for you. And I see some questions here. So let me try to answer some of those here. Sorry for just now getting to them. And like I said, I won't get to all of them. There's quite a few here. But it looks like someone said here, why has no one told me about a Roth? And as I'm sifting through these, one other one says, "Why does my advisor not talk about this?" So this is a good topic. So why has no one told me about a Roth? Well, one, Roth hasn't been around forever. 1997 is when a Roth started. Okay, and a Roth 401k didn't start until 2006. But remember, some 401k companies didn't put it in place until even after 2006. So you may have not had this option for a while is one thing. And so I would tell you that that is a pass that, okay, you may not have had this opportunity, but I would say, hey, you probably missed something because the Roth conversion, there is no limits on a Roth conversion. A Roth conversion has been allowed since 2010. And so we've seen Roth conversions be very popular, especially over the last 5 years with the low tax rates. And so if you don't have money in Roth, like I said, you could be missing opportunity because this has been a golden time to do it. If your situation's right for it. So that's one reason. Another reason why is in kind of go off the next question is most financial planners just don't talk about this topic. Most just do investment management. They're not going to help you with tax planning. They're not going to help you with retirement planning. They may not just plan retirements. They may just manage investments and work with whoever they can. And that answers the question of why does my advisor not talk about this is they may just not have the expertise and it may not just be their focus. You may be working with what I call the family doctor when you may actually want to look at working with a specialist as you get ready to retire or in retirement so you're making the right decisions in that phase. So I hope that's right. There's so many other reasons I could go into there, but for the sake of time, I'll leave it at that. And you can schedule, whoever asks that, you can schedule a discovery session with us and we can go in deeper to make sure you get a full answer there if that didn't suffice. Looks like we have another question here on Roth conversions. So I'll try to cover that and then we'll get moving. Should everyone do a Roth conversion? No, like I said, not everyone should, but let me dive into this further because it looked like it came after I covered that. We do have a rule of thumb of like who should look to do a Roth conversion and who shouldn't. For example, if you have $250,000 or less in investable assets, which shouldn't be anyone on the webinar because I think the webinar is specifically for people with $250,000 or investable assets or more. And the reason why is because if you have tax problems, if you have $250,000 or less, you're probably not going to have as much tax problems. But if you have $250,000 or more, taxes are going to start to be a bigger issue because every time you take out from these investments, it's going to increase your income. And so you're going to force yourself to be higher tax brackets and higher tax rates in the future. So our rule of thumb is that if you have $250,000 or less, Roth conversions may not be as important to you. But if you have $250,000 or more, you've got to get moving. And if you have $1 million or more, in my opinion, you don't really have a ton of options to wait because that RMD, which I think we're going to talk about next, is just going to continue to increase over time. And you're going to always be in a higher tax bracket is what we typically see. You're always going to force Social Security to be taxable. And so we want to make sure we're planning against those types of things. So hopefully that helps answer some of those questions here. Again, I'll try to check back here in a few more minutes and get some more of those addressed here. But I want to make sure we stay on pace. Required minimum distribution. So I've already talked about this topic. So starting at age 73, the government forces you to take out money from those IRAs and 401ks. And in this RMD, you have to take out about 4%, just under that, at age 73. And then by the time you're 90, you're going to have to take out 8 or 9%. And as you can see, the older you get, the more you're going to have to take out, which means you're going to have to pay more taxes. Your income's going to rise as you get further on in retirement, and we don't know what the tax rates are going to be as this RMD rises. And so we see this being a problem, as I mentioned, with people with $250,000 or more, especially with $1 million or more, because this plus Social Security and maybe you have a pension, all three of those combined are going to increase your income. And so we often get the question or the thought of, I'm going to be in a lower tax bracket in retirement. And we actually wrote an article on this topic and actually were able to prove this wrong, that you actually will probably be in a higher tax bracket in retirement if you have money saved in this tax-deferred investment that we've talked about. And it actually got featured in Kiplinger, this article. The title of it was, Will You Be in a Higher Tax Bracket in Retirement? And it was very interesting, and we had a lot of awesome feedback from it. But we were able to show that if you have RMDs and you have Social Security, for example, well, your RMD is going to force your Social Security now to be fully taxable where it could have been tax-free. And so those are the types of things, the problems that this RMD can force you upon. And so we need to make sure we're finding ways to reduce this RMD is what we're typically trying to do for the majority of our clients there. So typical advice is we got to find ways to reduce this. So that's all for the RMD there. So let's move along to what we call the widow's penalty here. So I'm sharing you a story with my uncle here. This is a fun one. So this is my uncle at one of our client appreciation event dinners we had. It was at a nice steak restaurant, and the guy shows up in overalls. And I know what you're thinking. The guy showed up in overalls to a nice steak dinner restaurant, and I have to tell you, I don't really care because this guy has been there with me since day one, and he was the first client when I got into the industry when I started many years ago. And you'll laugh because he's wearing these overalls, but I'm actually kind of happy because it's June, and typically in June he cuts them off right there at his knees, and he's being pretty considerate if you ask me because he could have came in with those, right? But anyways, the reason I'm showing you this example here because my Uncle Chuck just recently passed away, and that was the bad news, but the good news is we were able to prepare in advance to make sure that his wife, my aunt, was in the best situation possible moving forward. So that's what we're going to talk about now, which is called the widow's penalty. So if you are married listening to this, make sure you're planning for this before it's too late. If you're single, unfortunately, you're going to be at a disadvantage every year moving forward. And so I hope this helps emphasize for you that we've got to get moving now because we don't have as much room for mistakes. Okay? So that's the idea of this widow's penalty. So let's talk through it. So with the widow's penalty, the reason why the widow's penalty is a problem is because when one spouse passes away, their taxes could double. And the reason why is because you go from married filing jointly tax rates to what we call single tax rates. And if you know anything about that tax code, as we showed you earlier, the married filing jointly tax rates are much more generous than the single. Also, that standard deduction gets cut in half if you're single versus married filing jointly. And so we're going to show you an example here of how severe this widow's penalty can be. So we're going to show you an example one here that someone has a $60,000 RMD from their investments every year. And then we have Jill here who has Social Security of $24,000. And then we have Bill here who has Social Security of $48,000. And so that's their current income while they're married. And they're going to be paying about $11,000 in taxes while they're married each year. Well, what if one passes away? So if one passes away, what happens? Well, the RMD stays in place because the investments would just go over to the other spouse. And the big difference in their income would be the Social Security amounts. So one of the Social Securities would go away. The higher of two would remain forever passed away. And so if that happens, they are going to have a lower income. So my question is, okay, you have a lower income now that you're single because you lost one of the Social Securities. Do you think your tax rates will be lower, the same, or higher? And most people would suggest it'll be lower because you don't have as much income, which means there's not as much money to tax. Well, remember what I said earlier. Your tax rate's nearly double. And because of that, you're going to be paying a significant amount more in taxes even though you have a lower income because of what we call the widow's penalty. So my point here is, do you want to pay $17,000 later or $11,000 today, right? So this is more of an emphasis why we have to plan now for utilizing not only the low tax rates, but also these married filing jointly tax rates if you're married before they get cut in half in what's called the widow's penalty. So the reason I showed my uncle there is because he passed away just recently in January, and I was able to help them put together a plan to make sure that we could, for example, do things like the Roth conversion so that when my aunt goes and takes out money, she doesn't have to worry about paying taxes on that tax-free investment there of that Roth, okay? And so we were able to pay the taxes now at the more generous rates versus later when they're higher. And so you got to make sure you're planning for this now before it's too late is ultimately my goal with you to make sure you get out of that. So hopefully that was helpful there. Let me try to answer some questions here. One is there an RMD on a Roth? So I think that would go back. I'll just go back to the slide. All right, here. So with a Roth, there is no RMD. You can keep money in a Roth and let that grow tax-free for as long as possible, and you don't have to worry about that there. Whereas a tax-deferred, there are going to be the RMDs with that one. So question here is, can you clarify the age 73 versus 75? What I meant by that. If you were born in 1960 or after, your RMD age is 75, okay? For all you others on this call, it would be 73. So that's how you decide which age you take it. They've just changed that rule. It used to be 70 and a half, then it was 72, now it's 73, and then it's going to be 75. So as you know, the tax code's written in pencil, as I said earlier, as you can find out there. So looks like we have a question here. Can we schedule a time with your firm? So I'll have someone on our team pop up our link to schedule a session with us. You may have jumped on late, whoever asked that question, but at the beginning I told you that we'll have that scheduling link at the end, but we can just go ahead and pop it up now if you just want to go ahead and do that. And for that scheduling link, this is an opportunity for you to schedule that session with us. We don't charge for it. We just want to make sure you're implementing some of these strategies that we're talking about today correctly, and that you're in a better place than when you came and jumped on this webinar here. So hopefully that helps you with that one. So I'll go ahead and get moving. There's some other questions, but I'll go ahead and get moving here on our next topic here, which is going to be Social Security. So we're going to talk about specifically in this topic, Social Security tax. So many people are confused with this topic. Many people think when I get that $3,000 a month check from Social Security, I don't have to pay any taxes on it. And I'm going to tell you that used to be true, but may not be true today. And so before 1980, there was no tax on Social Security. If you got that $3,000 check, all of that was in your pocket. None of it went to Uncle Sam. I don't know about you, but I like that. Today, you could have Social Security tax-free, but if you don't plan correctly, you could also pay taxes on your Social Security. Meaning that if you get that $3,000 check from Social Security, you may not get to keep that $3,000 check. Some of that may go to Uncle Sam, and then you'll get whatever's left. And so how do we live in this tax-free Social Security environment is what we're going to talk about next. So if you remember the title of the workshop, the webinar here, is tax-free retirement. We're going to live a tax-free retirement. So I already talked about the standard deduction. We're going to come back to that. But we're also going to talk about how to keep your Social Security tax-free. And if I can tell you how to keep your Social Security tax-free, I'm sure you'll enjoy this webinar and think it would be well worth it, is ultimately what I like to believe. So who is Social Security not taxed to when you receive your benefit? Well, in my mind, there's two people. One is if you have a lower income. And so if you have a lower income, you've got to be poor, correct? And that is true. Or you could have a lower income and you could be considered smart. And so we have, as we talked about, a client that has $100,000 a year that they live on, and they have over $1 million. And so they're not poor, but they don't pay any taxes, so they're in low income territory. And that's because they're smart and they've done the planning over the years by working with us to get them to that position where they are truly living that tax-free retirement. So with Social Security tax, there's a period of time that if you can keep your income low enough, you'll pay no taxes. But as soon as your income reaches a certain point, you now start to force Social Security to become taxable, and it can go up and up and up over time. And there's actually something called the Social Security tax torpedo that I won't talk about in depth today, but I want to make sure you write that down. And this is a period of time when you start to force Social Security to be nearly fully taxable. Meaning that if you take out, for one of our clients the other day, if they took out $20,000 during this phase of time, then they would have to pay a 40% tax rate on that $20,000. Their income was not extremely high, but they just hit over that torpedo. And this is where most people can hit if they've got a good amount in tax deferred. If you've got around $1 million, you can hit this torpedo pretty quickly. And so if you hit that torpedo, that $20,000, they kept $12,000, Uncle Sam kept $8,000. I don't know if you want to give away $8,000 when you want to take out $20,000. You want to go buy a boat for $20,000 and you can only buy a boat for $12,000 because you forgot to account for taxes. And so what we're trying to do for our clients is we're trying to either keep them in front of that torpedo, or we're trying to keep them in the 0% bracket with Social Security. So we're either trying to keep Social Security tax-free, or we're trying to keep Social Security less taxed and not fully taxed. Okay, so those are the two main things we look at for our clients. So let's walk you through an example here. So we've got Bill, and Bill is what we call taking the IRS's plan. So in this example, we're going to show you Bill's plan and we're going to show you Jill's plan. And in both of these scenarios, they're both going to take $100,000 out a year. They're just going to change the way that they do it. Okay. So for Bill, he's going to be status quo. He's going to do whatever IRS tells him to do. He's going to take his Social Security at 62 like most people. By the way, I'm not here to tell you when is the best time to take Social Security because it truly depends. It depends on what is best for you. We tell people to take it at 62. We tell people to take it at 70. In this scenario, we're going to show you taking it at 62. In the next scenario, we're going to tell you taking it at 70. We're not telling you there's a right answer. We're just showing you the impact based on when you do take it and how you can use that from a planning philosophy and a planning standpoint. So if Bill takes it at 62, he's going to have a lower amount of Social Security, and then the rest of his money is going to come from his IRA because remember, he's status quo. He just saved into his 401k. He never took any actions. That's all he did there. And so if that's what Bill does, he's going to end up paying about $9,000 in taxes. Okay? So imagine this. You no longer have any income coming in anymore, but you still have to pay the government $9,000 in taxes. How do you feel? How do you feel knowing you're still paying the government a significant amount over your retirement? And so that's what the case would be if we just don't have any plan, and that tax rate would never go down over time. It would probably only continue to go up because his RMDs are going to go up, and Social Security is going to get cost of living adjustments. Tax rates are going to go up. He's probably only going to pay more and more taxes over time. So what would this look like if we just had a plan? And so we're going to talk to you about a real life example from one of our clients. Her name was Jill, and we're going to show you what her and her husband were able to do by just implementing these strategies correctly to put them in the best position. And so with Jill, she had what we call your plan, her plan, control is what we're ultimately trying to get at here. For Jill, we made 2 changes, and that was it. One of those changes I've already mentioned is we changed when we took Social Security. So we changed it from taking it 62 to 70. And the reason we did that is so that she could get a higher amount for one, obviously, but 2, now we don't have to take as much from our investments. The other change we made is we were able to integrate Roth into her plan. Remember how I talked about tax deferred, tax free? We're able to get more Roth and other tax-free vehicles into place for her to make sure that if she needs money in retirement, we have the flexibility of pulling out of which bucket we want to so that we can actually play the game the IRS is playing with us to make sure we can strategically keep our income low enough for what I call living a tax-free retirement. And so as you see here, here's what we're able to do for Jill. Social Security here, IRA, Roth. Because we integrated it this way, her taxes are $0. So let's talk about the steps of why this is the case. Well, you'll remember when I mentioned Social Security not being taxable if we can keep our income under a certain amount of period, right? And so we were able to do that because we took out from the Roth, okay? So that's one way. The other way is by having this Roth here, we were able to keep our taxable income under that standard deduction. So remember the standard deduction, $27,700. So we're able to keep our total income here under that amount, which means what is our tax rate? 0%. And so the Roth was allowing us to able to do that. Deciding when to take a Social Security was allowing us to be able to keep our income, this IRA withdrawal, under that standard deduction. So we always tell people, I see it was one of the questions there earlier, is should I move all my money to Roth? And again, the answer is no, but it does make sense to have a balance so that we can still take out from our IRA at that 0% bracket. That's why you don't want to convert everything, and that's why not everyone should convert, because maybe if you're already just going to take out money in that standard deduction, you're good to go. And that's why we say that $250,000 or less, if you remember. But we want more of a Roth flexibility here so that we can have that almost insurance to be able to tell when we want to pull it out and from where. So that's the idea, that if we can be tax smart, look how much money we could save over time. And so for Jill's case, we expect her to legally divorce the IRS from federal taxes, from Social Security tax, over time because of smart planning. And the good news is you can do it as well. You can do it by implementing the correct strategies to be put in place. So we mentioned the Roth conversion. That's one strategy. We also have, our firm has over 50 tax planning strategies that we go through with our client every single year to make sure we're not missing opportunities to put us in the type of position that Jill is, so we can save that $9,000 per year. And now what are we going to do with $9,000 extra per year? We're going to go on more vacations. We're going to spend more time with our grandkids. We're not going to worry about having to go back to work. We're not going to worry as much about running out of money. And if we can have that extra cushion, how would that make you feel? What more would you be able to do is ultimately the question that we want people to think about, because the importance of planning here, it doesn't take long to do tax planning. Get it set now, work with a professional, they'll do most of the grunt work for you, and then think about what that can do for you over the next 20 years. How much more comfort and peace of mind that's going to give you. So we can't encourage enough of the importance of tax planning. This is one of my favorite examples to go through to just show the power of planning, making sure you have a plan. So let's talk about this one here. So everyone thinks that the retiree's tax bracket is this. When I get to retirement, I just have to look at this bracket and I'll be good to go. If I want to do a Roth conversion, I'll just try to time it up so that I stay in the 12% bracket here. I'll just make sure my taxable income is right here, and I'll only have to pay 12% on that Roth conversion. Is that true? Of course not. Because taxes in retirement are much different than they are while you're working. In retirement, you have many other things to be concerned about that aren't going to show you on this chart. Does this chart show you where Social Security taxes play a part? Does this show you where Medicare premiums could cost more if your income reaches a certain amount? Does this chart show you capital gains? Does it show you net investment incomes? Does it show you the credits and deductions that you could phase in and out of? We have to have more of a comprehensive view of what we expect our taxes to be this year and moving forward. And so what we believe is the real retirees tax bracket is a software that we use with our clients to show how everything comes together. And this is going to be a really good picture for you to see how everything works together here. And so if we look at this chart here, you're going to see there's a lot of different colors. And so this is an analysis that we run for our clients every single year. It takes us a lot of time to put together and run the numbers and see what this looks like today and what it will expect it to look like in the future. But this is the one that we ran for a client the other day. And so what this is showing is obviously the blue here. That blue is going to be this federal tax bracket you're seeing here today. 12, 22, 24%, right? It's going to show you all those types of rates in this example here, okay? But what people forget is all of those other things that I mentioned. The dotted line tier here, that is going to be Medicare premiums. So the higher your income is, the more you'd have to pay in Medicare. If your income is above this, you'd have to pay $1,000 a year in Medicare premiums. If it's above this, you'd have to pay $2,000 a year in Medicare premiums more. And that's per individual. And so we need to know where that sits. So if we look to do a Roth conversion or we look to see where our RMD comes in at, we can be aware of if we're sitting above or under that limit there, okay? And then we have to worry about Social Security taxation that we talked about earlier. Remember how I said that the period of time where Social Security is tax-free? Well, that's what you're seeing right here. Not only is Social Security tax-free, and there's no purple in this phase, but you're also in that standard deduction where you're living that tax-free retirement, right? And so in this example here, you're not paying any taxes. But as soon as your income starts to increase, you're going to be paying almost 20% in taxes. And that may not be too bad, but look where you're at here when you combine that bracket here and also Social Security. Well, you could be paying almost a 30% tax bracket when that time comes. And you have to ask yourself, does doing a Roth conversion at 12%, 22%, 24% now make more sense now, or should we wait and pay it at 30% in the future when we take out these RMDs? And so that's my point, that most people will not be in a lower tax bracket in retirement. And the reason why is because Social Security is now taxed. And so if you have $1 million, for example, you take out $40,000, well, you're already going to sit in this area here. And where is that going to put you each year ongoing as that grows and grows and grows? And then you remembered me talking about that Social Security tax torpedo here, right? Where you could pay that 40 or 50% tax rate on that $20,000. We need to make sure we sit under this, is what we like to say for our clients, and make sure that we sit under here too. And so this is what we go through with our clients every year. If you schedule a discovery session with us, and I'll have someone on our team pop that up here, then we'll go through this analysis with you and make sure that you're taking advantage of these types of things and understood where do you sit and where your opportunities at. It's something we always want to make sure people are educated on. So this one's a great one to get that more intentional help there. And so as we look to wrap up here, and as you're scheduling that time, I want to think about this as a comprehensive, in a comprehensive way, right? All your life you've been working and saving. You probably haven't thought about a lot of the things I've talked about today. But then you get to retirement, things get a little more complex, and they're a lot different, and one or two mistakes can be so costly. And so we had a guy come to one of our workshops, and he was 3 years in. He scheduled a time with us, and he said, that slide you showed of the mountain was the best thing you showed all day. And he said, the reason why is because I'm 3 years in right now, and I need help. And this is something I'll never forget. He told me, I don't want to make a stupid mistake. He said, I've worked the last 40 years to get to this point. I don't want to make a few mistakes and put everything at chance. He said, I don't want to go back to work. I don't want to run out of money. I want to make sure I'm doing the right things. And so our biggest advice to you here today is make sure you're getting help. Get help from someone who's doing this type of planning. Get help from someone you can trust. Get help from someone who works as a team, not an individual, so that you have more people working on your situation so that you're in a better spot moving forward. And again, I'll have someone pop up that link to schedule here. And so you're more than welcome to schedule a time with us. We know a lot of people from these workshops want to schedule a time with us. We have 7 advisors at our firm. And so when you click on that, you'll fill in some information so that we can be best prepared for our time together. and then you'll be led to a screen to schedule a time with us. And like I said, all 7 of our advisors' calendars are on that, so we've tried to free up as much time as possible for that session. So you can go ahead and do that, and we'll do either a phone call or I think what we'll do is a Teams meeting. So we'll send you a link. Very easy to do. You'll click on the link, and then you'll be able to see each other on that screen to get any questions answered and just see where you're at. And we'll give you an analysis to say, hey, here's the things you're missing, or here are the things that you could consider further, is ultimately what we're looking at there. And a little bit more just about our firm here. We are a boutique firm, so we don't work with everyone. So I want to make it very clear that we get a lot of people that schedule times with us with all these webinars we do, and we just want to be very transparent that we cannot serve everyone. I don't want this to scare you from scheduling, because anyone that schedules will help you. But just understand that we have a specific niche that we serve best, and we don't work with everyone. Some firms will work with everyone, but in my mind, you can't deliver a better service to your clients if that's the case. So in that session, it is also an opportunity for us to see if we could be a good fit to work together. And if so, we can explore further after that initial call. But if it doesn't make sense for us to work together, we feel like we can't add the value that you're looking for, we'll either make sure you're pointed in the right direction, or at least have enough guidance to do some of this on your own. So those are what we have to offer there with that discovery session. We're here to help. We want to make sure you're in the best place possible. We'll also send you a folder. So in that scheduling link, there'll be a place for you to put in your address. We'll send you a folder here, and it just explains a little bit more about our process here, what you're seeing on the screen. It's called our 5-pillar approach. There's just a little bit more in here about us. You can get to know us a little bit. And in here, that Kiplinger article I mentioned is actually in here as well. And we just want to give you some information, get to know a little bit more about us. And so, for that call, we can make it fruitful for you as well. If you have any questions beforehand, just put it in that link as you schedule a time. And so we'll have that in there and make sure that you're in the best place possible there. So we're getting close to the end of time here. I know we still have quite a bit of questions there that need answered. So I'll go ahead, if I haven't answered that, just go ahead and schedule a Q&A, that session with us, and we'll answer all those questions in that session and make sure that you're in a better place than what you came here for. So we're looking forward. I already see some people have scheduled a time there. It looks like some emails have come through that some of you have scheduled, so that's great. And we're going to look forward to trying to help you here further. And like I said, answer any questions and make sure you're in a better spot. So thanks for joining today on this webinar. Hope you enjoyed it. And we'll look for talk to some of you here soon. Bye now.